India's market news headquarters. Cutting-edge analysis. Influential insights. Market-moving intelligence. Broadcasting live from the CNBC-TV18 Motilal Oswal studios in Mumbai.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. We are coming to you live from the CNBC-TV18 Motilal Oswal studios. It's looking better. It is looking much better. And we'll tell you why over the next 1 hour or so right into market opening. I'm Prashant. With me, my colleagues Nigel and Sonia. Guys, hi, good morning.
Hi, good morning. Anything can look better than what we saw yesterday, right? I mean, and of course, everyone's hoping that the dips get bought. But let's see. We have a long day ahead. But the good part is there's a gap-up opening expected.
Well, that's right. And we'll need to build on from there, which will be very, very important. And a big day coming up for the markets. And later tonight, a big day as well for the Olympics when India plays that crucial semi-final.
Okay, absolutely. And I think let today in the market also be a bit of a semi-final.
Big day.
You know, absolutely. So let's rewind the clock back as we always do and tell you what you need to know as we begin another session, right? What was the big worry on Friday and which kind of triggered all this mayhem and sell-off in the US and then in Asia yesterday? It was the jobs number, the labor market data, which had weakened so much. So I want to start with a data point which is right in the opposite direction of that data point. And this is the ISM Services Index, which is now rebounded in the month of July to 51.4. This is strong data as opposed to the weak labor market data. You know, if you look at this, all subcomponents expanded. And you also had the employment index within the ISM Services Index, which actually rose, which expanded. This is in contrast to the labor market data, which spooked markets, sort of sparked off recessionary fears, etc., etc., etc. And I think that is basically something which provided a sigh of relief for markets. Remember, in the US, it's not a data-heavy week. So this is one of the few data points which we are going to get. And this came like this. Remember, services is about 55-60% of the US economy. It's much more stickier as compared to manufacturing. And this number shows that you know the economy is fine. I mean, it's not showing any recessionary trends. Now, and price action reflected in this as well. I'll get to the price action in just a bit. But one more thing, you also had the Chicago Fed president who was interviewed on CNBC. We'll play out the sound bites in a bit. And he said he kind of did not rule out any emergency rate cuts and emergency measures. But he said it doesn't look like the U.S. economy is in a recession. But he also assured that if the economy deteriorates, Fed will, and I quote, fix it. Now, we've seen the Fed trying to fix the economy many times in the past. Not the economy, but the markets more so. Last, of course, was trillions being printed during the COVID emergency, and before that, during the global financial crisis, and so on and so forth. So there was at the margin this which played as well. So what did equities do? You had the US market, which ended down. S&P was down 3%. NASDAQ was down 3.4%. But the point is, from the lows, there was a sharp recovery. And that's the next graphic. So S&P bounced 1.3% from the lows, and the NASDAQ recovered 3% from the intraday lows as well. You had the CBOE Wix, which closed last Friday at 23. Pre-market US, it had jumped to 65. It finally fell and closed at about 38. So 23 on Friday, 38 as of yesterday's close as far as the US is concerned. Bond yields ended absolutely flat. The 10-year lost 1 basis point, so no incremental pressure there. We left off at about 3.78% last night. Now, you know, the point with regards to the US session that I want to make is, you know, yesterday in Asia, it looked traumatic. It looked uncontrolled, unhinged, right? I mean, the way markets were selling off, circuit limits were being hit, etc. By the time it got to the US session last night, it was much more orderly. I mean, if you read global stuff, a lot of people are talking about it being a more two-way market. There were lots of sell orders, but there were a lot of bids as well out there in the market. Even though the S&P ended 3% lower, the NASDAQ ended 3.5% lower. It was a more two-way market. It was more orderly. There were exits, but it was orderly. And I think that is important to note. Now, the other talking point, of course, yesterday was the yen. And yen did not sort of break levels. It hit about 142. And then it paired gains to 144. So it depreciated. The yen depreciated against the dollar to about 144 by the time things ended in the US. And this morning, Nikkei is seeing a sharp rally. I mean, it's basically recouping almost all of yesterday's 12.5% losses. And we'll talk more about that. That's, of course, a live market, so we'll have to look at rates as we come along. I think, and it may be a sort of, it perhaps is early. It is early because we've just had 1 or 2 days of panic, but maybe the bulk of the panic is done with what we've seen last night in the US and the way the market sold off in the US. The panic is done. I mean, you know, hedges and hedge funds, etc., would be out. Large financial institutions who had to forcibly unwind would be out. Retail is a different matter, especially with Japanese money, etc. But I think for once, for the time being, that panic kind of situation perhaps may be behind us for global markets. Now, just to circle back to the levels, it would be great if the Nifty defends yesterday's lows, which is 23,894. It's the nearest level. Strong support below that at 23,628. What is that? It is the 38.2% retracement of the rally from the lows of the election low, which is the 4th of June, to the recent high, which is 25,000 plus. That number is 23,628. And watch for a positive daily close, which should give us the first indication that maybe we are getting past this. Unlike the Nifty, Bank Nifty yesterday already retraced 50% of the rally from the election lows. So it's a much more weaker setup there. On the way down, 49,718 will be an important support. And below that, the Nifty Bank will see support coming in only at the 61.8% retracement, which is 48,858. GIFT Nifty comes up on your screen. It should give you an indication of the start. 200 points higher, right at the word go. I'm not expecting a huge V-shaped one-way kind of a rally, but the point is maybe it's more stock-specific, more discerning. Everything got ignored with the global sell-off, and I think it's maybe time to get back into stock-specific opportunities and situations and look at it as a more normal market without all the panic we've seen over the last 48 hours. Sonia.
Oh, absolutely, and there was a lot of panic, right? So it's really a relief to see this 190-point up move on the Nifty. But you can't rule out volatility in this market. At least that's one thing. Remember, the India VIX had a huge spike up. It's at a 1-month high. So some more volatility is something that you can perhaps expect. Let's also tell you what happened overnight, right? I mean, the Dow was under a lot of pressure, so no two ways about that. The Dow was down about 1,000 points in trade, and there was large selling by foreign investors in our own market. So if you look at it, FII sold 10,000 crores in the cash markets yesterday. The good part in all of this is that crude prices have fallen. So NYMEX is at a 6-month low now on the back of recessionary fears, and falling crude prices is always good for a market like India. So keep that in mind. This morning, a lot of the Asian markets have opened with big gains, right? So the Nikkei market is up 10%. It's regained all of its losses. The US futures have recovered as well. So there are some important questions that I'm asking. One is that will the dips get bought? In all likelihood, it will, given that there is some green on the screen. So perhaps you should go out there, get your shopping basket ready and look for opportunities that maybe you didn't get a chance to invest into when this market was, rallying. Also, is this the first real correction in a longer bull market, which means that could this correction extend further? If it does extend further, then perhaps the best thing to do would be to wait and watch. These are a couple of, questions that need to get answered. But for now, there is a big rebound in the Asian markets. Remember, there were historic losses yesterday. The Nikkei is up 10% now. And let's not forget that give and take everything, right? The Nifty has given you a 12-13% compounded return over the last 15 years, despite a pandemic, despite a war, despite a financial crisis. So just keep that in mind when you look at steep losses, and perhaps there's no need for any kind of panic.
Well, that's right. Let's look at the trade setup then. And there are signs that the global markets, they are stabilizing, at least this morning itself. You have the Asian markets that are trading in the green, and the CBOE volatility index. It ended much higher in yesterday's trading session in the United States, but it came off close to around 40% from the peak of the day. So that's good news. The Indian markets, well, they've been outperformers. I say that because the Indian markets, well, we've corrected close to around 4% from the peak. But you have markets like the Kospi that's down close to around 8%. And you have the other Japanese markets and the likes, the Nasdaq, that's down more than 10 to around 15%. So that's why India has been outperforming. And I expect the Indian markets to continue to outperform from here on. In terms of the domestic queue, you'll have the Nifty Financial Services Index that will play out to weekly expiry as well. But let's get to the other data points. The FIs, well, in yesterday's trading session, the long position, the net long positioning has come down to around 1.1 lakh contracts because they unbound some long positions and they added short positions as well. So from close to around 1.5 lakh contracts, that's down to around 1.1 lakh contracts. The client positioning, well, there has been some covering of shorts. Remember the client short positions had moved to around 87,000 odd. Well, that's gradually come down lower. So there are signs of short covering from the clients as the markets have seen a bit of a dip. In Friday's trading session, we ended lower. Even in Monday's trading session, we ended lower. And that's calling for some short covering from the client's positioning. I'll view this positively because they have been getting the direction of the market right. Yesterday, it was a weak session. So the call writers, they came back into play. And because of the kind of call writing that we saw, we did see the PCR come down to the lower end of the range. Remember, at around 0.65, 0.7, normally you see the Nifty see a bit of a bounce back. And the reason we came down to this level is because yesterday the 24,500, 24,400, 24,300 call, all of them, they did see a fair bit of writing. Now this 24,200 call, well, these call writers will get a little bit nervous because the GIFT Nifty is suggesting a gap up and those writers could be in trouble. So we'll have to keep an eye on this strike, whether we see some unwinding at this particular strike. Moving to the levels then, well, the Nifty, we're seeing a bit of a bounce today, but you'll say that, a fresh breakout will come about only once we get to the 20 DMA, which is quite a distance away from where we are currently. Support levels, 23,800 is rather important. The 50 DMA as well comes in around there. And yesterday as well, we went to close to that level. So that's the important mark on the downside. The 100 DMA, well, if that 23,800 breaks, then we'll see a further downtick. Since today's the Nifty Financial Services Index expiry, let's look at a couple of strikes. Well, we had the 23,000 call that had a fair bit of open interest built up. The premium ended at around 29, but at some point of time, it was close to around 150 to 200 odd. So the crucial resistance level on the Nifty Financial Services Index is 23,200. The start's in the green. We need to build on from there and take out those crucial levels.
Okay, thanks a lot for that. So lots to watch out for as we begin a brand new day of trade. And thankfully, as we've been telling you, there is some relief that we're looking at this morning, especially across most, global markets. But on the equities front, we have first up a comment coming in from Mahesh Nandurkar of Jefferies, who says that the higher risk of a US downturn now factors in a 132 basis points Fed rate cut by December 2024. The consequent US dollar weakening should augur well for Indian stocks on a relative basis. But on an absolute basis, the risk is on the downside, given one of the longest streaks of the bull run, unsustainably high domestic retail flows and potential capital gains tax hikes in the future. They maintain a defensive stance and their preferred large-cap laggards are private lenders, staples, L&T and two-wheelers.
Okay, this is another interesting view. This is Victor Schwetz of Macquarie, who says that given the sell-off in Asia and the spike in wicks above 50, the question is what dangers are investors facing? Does it require joining the stampede or create a buying opportunity? Victor says the sell-off was precipitated by a confluence of events. That is perception that the Fed is behind the curve, investor concerns that the tech bubble is bursting, third, potentially disruptive unwind of the yen carry trade, and authoritarian regimes view such volatility as evidence of fragility of the West, potentially encouraging geopolitical adventurism. Although stampedes are inherently unpredictable, they are viewing this as closer to irrational, thus creating buying rather than selling opportunities.
Okay, and let's also get you some money market views because the rupee has been hitting new lows as well. Abhishek Goenka of India Forex and Asset Management says the rupee has underperformed amidst broad dollar weakness. While until last week it was the best performing Asian currency, it has slid into the middle of the pack with the ringgit, Singapore dollar and offshore Chinese yuan overtaking it. With high carry and low volatility was the beneficiary of carry flows. Hence, he expects the rupee to continue to underperform amidst risk aversion, but does not see a runaway depreciation. In the medium term, the rupee is expected to trade in a range of 83.40 to 84.40.
On bonds, Vishal Goenka of India Bonds says that extreme and violent price moves marked trading across assets in global markets in the past few trading sessions. What started with Bank of Japan's move last week quickly transformed into yen currency unwinds, resulting in shock asset price moves across bonds, equities, forex, and spikes in volatility all across. India remained fairly insulated so far, and he expects the RBI to stay on hold and vigilant at their policy announcement due on Thursday. He expects bonds to face resistance this morning with a bounce in Japanese equities and the 10-year benchmark bond yield to trade between 6.86 to 6.92%. Also anticipates global volatility to continue this week as well. Well, that's lots of views, and let's get some more with Daniel DiMartino, Booth, CEO and Chief Strategist at QI Research. Daniel, great to have you with us here. Good morning. Appreciate your time here on CNBC-TV18. So is the global panic done for now, Daniel? Simple question.
I think it is. I think that there was, I think the pendulum swung too far and that the sell-off was too deep. And this is what we anticipate and expect. This is how markets behave at these kind of big inflection points. We saw the same type of behavior in 2000. We saw the same type of behavior in 2007, going into 2008. Markets trade in a very jagged fashion as the economy is turning. And I think that that's where we are right now.
Okay, but what about the whole issue that with the yen carry trade and what's been happening with the Japanese market? Do you think even if we see a bit of a pullback and the worst is over, we could be heading into a very volatile phase globally? And if that is the case, then how does one approach markets like India?
Well, I do think, I was trying to say that I was expecting a lot more volatility going forward. We know that more than half of the positions that were short the yen at the beginning of July have been since worked off. So we can say that we're more than 50% of the way through the unwind of this carry trade. But I think that there are so many different things going on in the global economy right now that the base case is going to be for continued extreme volatility. We have to remember that there was a day last week that the NASDAQ QQQ, the NASDAQ 100 was up 5% in one day last week. So again, I expect this volatility to continue as there are so many different sources right now that are feeding uncertainty.
Hi, Danielle. Good morning. I recall the last time we chatted, you said maybe the US markets is towards the last leg of its rally. And you got it right, seems like, because post then the US markets have corrected. But the two markets you were positive on, one was the Mexican market and the Indian market. How do you approach both these two from here on?
Well, right now, the Mexican market is a bit riskier, much riskier because of the potential for contagion from the U.S. hard landing recession and how that's going to be affecting that country. I have high hopes that the new president will implement long-term good strategies. We're still long-term positive for Mexico. We certainly think that the peso sell-off has been overdone just in the last few days. But I think that you'll have a little bit more stability, if you will, in the Indian market going forward, given how closely Mexico's and the United States economies are tied to one another.
So from the emerging market basket, India is still the top pick?
India is certainly, I think one of the better picks right now. Remember, the MSCI Emerging Markets Index today sold off by 4.2%. So to your point, you have to be very choosy with where you are within the emerging markets complex. I don't think that at this juncture you can just own the broad risk asset at this point. You have to choose.
So with all the volatility that you're expecting, Danielle, is the up and up, continuous up move. I mean, India and US have been the two best performing markets. I mean, actually throw in Japan there as well. Do you think that phase is kind of broken, or what's your view?
Yeah, I think that we have seen the highs for the market. We've seen more than 100,000 job cuts announced over the past 4 months in the United States. Last week, we had a very large announcement out of Intel Corporation, almost 20,000 jobs. Today, we had one from Dell Technologies, I believe 12,500 positions. So I think that the market is beginning to recognize recession. We saw the yield curve uninvert it was just a hot minute today, but boy, that really got the market's attention. The fact that the 10-year yield was finally where it should be on the yield curve, if you will, the yield curve steepening. So I think we're getting enough signposts to suggest that if the U.S. is going into recession, that we've seen the best we're going to see out of stocks.
All right. Thanks a lot for that, Danielle. Always appreciate your time here on CNBC-TV18. Let's slip into a quick break. On the other side, our list of top 10 stocks is coming up with our entire research team, so don't go anywhere. Welcome back to Bazaar Morning Call. Well, expect a gap-up opening today after a strong rebound that we've seen in the Asian markets, and that green is really coming as a big relief given the kind of, setback that we saw yesterday. But our research team is standing by with a list of top 10 stocks for the day. ONGC is the first one on our list. Let's find out why you should be tracking that one. Sonal, good morning.
Good morning, Sonia. Well, ONGC reported numbers which were better than estimates. Margins were higher largely because of lower operating expenditure. The profits lower than estimates. That is largely because of lower other income on a quarter-on-quarter basis, higher depreciation and higher tax rate as well. But if you look at the numbers on a quarter-on-quarter basis, revenues were up 2%, EBITDA increased by 6.8%, margins came in at 52.7% versus 50.2%. Profits were down 9.4% for the reasons that I mentioned earlier. But these are better than what the street was working with. Crude production and gas production, both of them have declined 2% on a sequential basis, slightly better than street estimates. The conference call is at 3:30 p.m. today. We'll get more idea about discoveries and also the production from KG Basin. Jeffrey says the numbers were better than what they had estimated. They have a buy with a target price of 390. Crude also has recovered a bit, so expect some green on this stock today.
Okay, thanks a lot for that, Sonal. Well, let's hop across to Rima, who's here to tell us about Bharati Twins, who had reported their numbers. Morning, Rima.
Hi, good morning. So let me start with Bharti Airtel, where, some would say it's in line. Some are saying it's a slight miss on the margins. So the company has reported a consolidated revenue growth of 2.4% in line with expectations, but margins at 51.8% fall short by about 30 basis points. Again, not too much of a miss, and the miss has come in on the enterprise business. The India mobile business has reported a revenue growth of 2.1% ahead of what its peer Reliance Jio has reported. Margins have expanded by 50 basis points. The ARPU growth is modest. From 209, it's become 211. But remember, the big ARPU jump is only going to come in Q2 once the tariff hike takes effect. Subscriber net adds too at 2.2 million. So on the whole, it's not a very exciting quarter. But, considering that, the whole market is going to be in the green, I'm going to go with green for Bharti Airtel because there's nothing so bad in the numbers, for it to, come under severe pressure. Profits, though, have jumped up by more than 100%, boosted by an exceptional gain. Here, the conference call is at 2:30 p.m. Bharti Hexacom is again slightly lower than street expectations. Revenue growth of 3.7%. Margins have declined by 120 basis points quarter on quarter. Profits, if you adjust for the exceptional gain, are down 13% on a quarter-on-quarter basis. And this is a stock which has outperformed its run-up since its IPO earlier this year. So, it's slightly lower than expectations. Back to you.
All right. Thanks very much, Rima, for that. So that's Bharti and Hexacom in focus today. But more numbers. Tata Chemicals, Deepak Nitrite, Sonal is here with details. Sonal, good morning.
Good morning, Prashant. Well, for Tata Chemicals, it was a big decline on a YY basis. If we look at the EBITDA, that was lower. Operating profit margins at 15.1% versus 24.7%. Profits were also down by 67%. But what was the positive? The positive is that margins have recovered on a quarter-on-quarter basis. They have come in at 15% versus 13%. And in their commentary as well, the company says that their India business demand was quite stable across all end-use industries. In America, demand was flat. In Europe, they experienced muted demand. But they were facing a big competition coming in from Turkey in terms of dumping at lower prices. That they think is going to end soon because of global problems and freight cost issues as well. So that is a positive there. For Deepak Nitrite, it was a good set. On a YOY basis, the revenues increased 22%, EBITDA 47%, margins improved around 300 basis points, leading to a profit increase of 35%. This was led by the phenolics division. So while the advanced intermediates saw an EBIT decline of 42%, phenolics saw an increase of 137%, and that is the reason we saw that beat on numbers today.
Okay, thanks a lot for that. Well, Vamakshi is also joining in to talk about Schneider Electric, BEML, Triveni Turbine. She has her hands full this morning. Vamakshi, good morning.
Good morning, Sonia. Let me first start off with Schneider. The company reported a good set of numbers. Revenue was up nearly 20%, and this was largely being driven by strong sales growth as well as better mix of transactional and services segment. EBITDA margin too saw an uptick of almost 380 basis points to 13.8%, driven by a better product mix, order pricing and operational efficiency. Resultantly, the net profit surged by almost 40% on a YOY basis. The order inflow too was healthy, up nearly 19%, coming in at 531 crores with good momentum seen across ordering activity across all the segments. The order backlog resultantly came in nearly 16% higher. BEML, on the other hand, reported a weak set of numbers. Revenue grew by almost 10%, but this is much lower as compared to what the company had guided for. They had guided for 20 to 25% growth in the top line for FY25. EBITDA loss of 50 crores is what the company has reported, the same as the same quarter last year, and they've also reported a net loss of 70 crores. Order book saw an uptick of almost almost 21%, of which nearly 3,400 worth of orders are executable in the current year. So overall, a weak set coming in for BAML. But lastly, let's focus on Triveni Turbine. It's a strong set, beat across the board. The company has reported the highest ever quarterly revenue, EBITDA and order booking. Revenue saw an uptick of 23%, largely being led by the domestic business mix. EBITDA margin came in nearly 180 basis points higher. It came in higher than estimates as well. Net profits saw an uptick of 32%. They've also managed to report the highest ever quarterly order booking of 636 crores, and this is largely being driven by exports, but domestic order booking was rather muted on account of the elections. But overall, good set for Triveni Turbine as well.
Thanks a lot for that, Vamakshi. Well, let's wind this down then with Sudarshan, who's here to tell us about a few more stocks that he's tracking. Sudarshan, take it away.
Morning, Nigel. So we'll start with V-Mart Retail. On the bottom line, company has reported profit against loss in the same quarter last year. Profit has come in at rupees 12 crore versus loss of rupees 22 crore. Revenue was up 16% and margin has expanded by 500 bips year on year. Even internals are looking strong. Same store sales and same store volume both were up 11% each. Footfall has risen 36% and sales per square feet per month was up 13% year on year. And for Lime Road business, losses have seen a sharp reduction. On year-on-year basis, losses have reduced by 60%, and on a sequential basis, it has come down by 15%. For Aarti Pharma, I'm going with green just because of healthy revenue growth. Revenue has increased by 21% year on year, but margin was lower both year on year and sequentially. EBITDA was up 14% and profit has increased 18%. Guidance for FY25 company has maintained it. It expects EBITDA growth of approximately 10 to 12% and it aims to achieve long-term goal of about 15% annual growth in the next 3 years. So I'm going with green for both V-Mart Retail and Aarti Pharma.
Okay, V-Mart Retail and Aarti Pharma. Thanks a lot for that. Here's a quick recap of our top stocks. Stocks with positive news flow: ONGC, Bharti Airtel, Tata Chemicals, Deepak Nitrite, Schneider Electric, Triveni Turbine, V-Mart Retail and Aarti Pharma, while stocks with negative news flow is Bharti Hexacom and BEML. The good part though is that crude prices have fallen and that's always good for a market like ours. So Manisha Gupta is joining in to tell us the latest in the commodity markets overnight. Manisha, good morning.
Morning, Sonia. Thank you for that. Well, yes, the commodity has seen a pause after the sell-off that we saw in the markets yesterday. The crude oil prices did hit a 7-month lows, but we've seen nearly a percentage point of gain come in for the Asian markets right now. Well, there are concerns about weak oil demand. The geopolitical tensions in Middle East, though, also add to uncertainty. The area that has continued to decline and has extended further decline today is the metal prices. Poor demand, rising inventories, weak economic data, sell-off in other asset classes, recession concerns in US, almost everything seems to be weighing onto this space. So from its highs in this year, most of the metal prices now are down by 15 to 25% on the lower side. Markets will, of course, watch out on how the stability comes back in the global market. But until then, there is really no reason to buy into metals. Further declines, almost by 0.5 to 1.5% down across sector.
All right, Manager, thank you very much for that. I mean, Chinese data, terrible. We look at the PMI numbers, big contraction there, no rebound. And China, of course, the margin is the big incremental buyer still across all commodities pretty much. We take a break. Amnish Agarwal or Prabhudas later is going to be joining in with more fundamental stock analysis. Stay tuned for that.
Welcome back. You're tuned into Bazaar Morning Call here on CNBC-TV18. Abneesh Agarwal, Head of Research at Prabhudas Lilladher, joins us on the show to help us out with some fundamental analysis. Hi, Abneesh. Thanks a lot for joining in. Well, let's analyze a few stocks then. We had Bharti Airtel that came out with its set of numbers. How are you reading those numbers and what's the view on the stock from here on?
You see, Bharti numbers were quite good. And the main thing is that the ARPU increase which has happened and the price increase which happened during the quarter, they are yet to fully flow into the numbers. So I think from the medium to long-term viewpoint, Bharti continues to look as an interesting stock plus. I think as the time goes by, I think the growth will be there and the stock will continue to make new heights.
Okay, that is on Bharti. Given that we've had such a big fall, Amnish, what is your view now on how to approach some of these large cap names, whether it's banks, IT stocks? if this dip continues and you have to buy into it, what would your shopping basket look like?
You see, first of all, my view is that the yesterday's dip is more like temporary. There is no inherent change in the fundamentals of India as a market or as an economy, and this dip is related to the global geopolitical uncertainty plus the expected change in the global capital flows. While it can have impact in the near term, but I think in the longer term, the fundamentals, they will remain intact. Now, at the current juncture, I think we have seen yesterday a big cut across, sectors, whether it was banks, whether cap goods were there, autos were there. So I think very broad spectrum of stocks which have seen big cuts. So I think there is no specific name, I would say, in terms of, shopping basket. I think all the frontline companies where the fundamentals look good, whether these are, for example, like Reliance, the frontline banks, you can see the frontline stocks in the capital goods. Okay, FMCG companies, they didn't, I would say, correct. Even the large cement names like your Ultratech and Ambuja. And then you can look at, some of your names like even the port companies. So I think one should look very broadly because the fundamentals, there is practically no change. So there might be near to medium term volatility that can't be ruled out. But on the lower levels, it be, I think, a good time to go for the companies which are well placed, where the balance sheets are strong and the business mode continues.
Specifically, Amnish, hi, morning. Autos, right? The Nifty, I'm looking at the Nifty Auto Index. I think it's seen one of the sharpest cuts. Closed at 24,700 yesterday. The high on Thursday was almost 27,000. So from 27,000 to 24,700 in 3 sessions now. What's the big fear here, and what do you do here? What are your calls?
You see, I think auto is having two things. First of all, we have seen that particularly the PV market is showing some signs of a slowdown. If you exclude, say, M&M, look at all the other PV companies, I think in the last 2 to 3 months, the sales growth there has slowed down considerably. That is one. Secondly, if you look at, say, past year or so, many of these auto stocks, they have given even up to, say, 60 to 80% returns. And the third is, if you look at the geopolitical situation, whatever happens in the commodities, and particularly if you look at the large company like Maruti, so there will be impact of, say, the currency volatility also in some of these companies. So that is one reason we might have seen, sharp, some sort of a pressure in some of these stocks. But I think barring Maruti, where we will have to see how the Japanese yen, I would say, stabilizes and other things go, I think that there is no big change in the fundamental for rest of these stocks. And after, I would say, reasonable correction, I think some bit has happened today. There might be, a little bit here and there more. But I think the calls practically remains the same. In the long term, Maruti continues to look good. M&M continues to look good. And among the two-wheeler stocks, Hero is the stock which we have been liking.
Okay. No, I mean, that's one space which has seen a fair bit of damage. The Nifty, I'm just looking at the last 3 days, is down 4%. The auto index is down 8.5%. So, the damage is much more. There's information at the bottom of the screen as well. Sources are telling CNBC-TV18 the government is weighing an option if an option can be given to stick to the old capital gains tax regime for real estate. So it's like the old and new regime, and the government prefers grandfathering be given till 2024. So these are important flashes which are coming, which we will address in just a bit. No decision has been made, but from a real estate perspective, I think it's going to be such a big thing if this were to come through. A lot of angst after the change was made about removing indexation benefits. But let's focus on the market, stay with the markets. Anuj is here with how he's looking at the market. Anuj, good morning.
Good morning, Prashant. You and I both were there when we had this 2008 kind of play out. And if we had this kind of screen, global screen in 2008, the Indian market would have easily fallen 10%. But it's the strength of the inherent strength of the Indian market that we actually fell the least. If you look at our peers, and after 10,000 crores of selling, Nifty fell 2.7%, which is really par for the course. And as I said, in 2008, in such a scenario, we could have easily fallen 10%. Now, for the morning, at least the Qs are looking slightly good, in a sense that it looks like we are in for some short covering bounce. Whether it sustains or not is the big question. The put-call ratio at the zone of 0.72. Global screen looking much better today. Of course, the big question will the recovery last? And the most important cue last night was the US CBOE VIX. Intraday, it went to 66 from I think 23 or thereabout, and then it cooled off and closed at 38, signaling some kind of intermediate bottom in the US market. I think that's the cue that the Japanese market and the Asian markets are taking, with the US futures also being up, and most of the markets today are up. Look at that number, 10,074 crores selling by FIIs, but all of it dollar to dollar absorbed by DIIs, 9,100 crores. FIIs also sold in cash in index and stock futures, 2,400 crores in index futures, and sorry, they bought in stock futures about 1,390 crores. In terms of positioning, 11,000 long contracts were cut yesterday, and about 23,000 shorts were added, which means that we are now at 60% net long. Remember, we were at 1.88% net long. We are now down to 60% net long. And in terms of contracts also, it's about 1.1 lakh contracts. Coming to levels now on the Nifty, the first resistance would be 24,300 to 24,350. Yesterday's double top on the intraday chart. And then 24,450 to 24,550. That's where option writers are placed. And that's where the most important level, the 20-day exponential moving average, is also placed. Support comes in at 23,900 to 23,950, and then 23,400 to 23,500. And the bank Nifty has been quite weak for last few days. It closed below 10, 20, and 50-day exponential moving average, and just somehow defended the 100-day exponential moving average, which is the support, by the way. In terms of resistance, 50,500 to 51,000, and then 51,300 to 51,500 is the kind of resistance that I'm looking at in this market. Quickly leave you with the quote of the day, and that would come up for you on the screen. This is interesting. I don't know who's written it, but the quote is good. When shifts and transitions in life shake you to the core, see that as a sign of greatness that's about to occur.
Okay, thanks a lot for that. Very helpful there. Sane advice coming through both on the markets and on life, as always. Thanks, Anuj, for that. Well, Amnish Agarwal is still with us, Head of Research at Prabhudas Lilladher. Amnish, I wanted your thoughts on ONGC, the numbers, the stock, and as a long-term investor, how do you approach it now?
You see, in the overall volumes has not been there much, and given the fact that the stock has seen a big rally in the you can say last 12 to 18 months, the stock seems to be, I would say, fairly priced. So in comparison to your oil, the companies, in comparison to ONGC, we are more comfortable in Oil India, where there's more production going to increase because one of their oil fields has gone live. So there will be some volume growth over the coming 2 to 3 years. So we are preferring Oil India over ONGC. It is not going to be very encouraging in the near to medium term.
Okay. Thanks for that, Amnish. Have a good day. Thanks for joining in. Let's talk about BLS International now. The company reported a strong quarterly performance with the margins at a multi-quarter high. Profits jumped 70%. Their visa and consular revenue also witnessed a strong growth. Shikhar Agarwal, the Joint Managing Director of BLS International Services and the Chairman at BLS E-Services, joins us now. Shikhar, thanks a lot for joining in. You know, in your visa and your consular business, you saw a very good growth. What led to that, and what kind of sustainable growth do you see for the rest of the year?
See, definitely, if you see in the visa and consular business, we grew 35%. And, if you see at the EBITDA level, we grew 70%. Even the margins now has grown to 27% from 21% earlier. So definitely, I think the levels that we've achieved is sustainable. This is the new base of the company. We've been talking about increase in margins from the last few quarters. That has been, there have been a variety of factors for that. Change in partnership model, increase in service fee, new contracts at higher service charges. So definitely, I think those are the factors that have led to increase in margins. And if you talk about increase in revenue, we've had a volume increase as well. 18% volume increase in terms of visa numbers, from new contracts and existing contracts. And I definitely feel these levels are sustainable.
Okay. Hi, Shikhar. Good morning and good to see you. And as always, you've completed the iData acquisition, right? And that was likely to help you in terms of market share, I think, in the European region. Could you tell us what will be the financial impact that we start seeing from Q2 onwards? If you could quantify it with some numbers, because on a quarterly basis, it'll start giving you some numbers.
Yes. So Nigel, the first quarter numbers definitely do not have iData consolidation. We completed the transaction on 10th of July. Last year, calendar year, iData follows a calendar year. They did a revenue of around 300 crores and an EBITDA of 144 crores. So definitely, I think that could be maintained this year. So on a quarterly basis, I think 25 to 30 crore of EBITDA would probably be added. So I feel that that will start coming in. And as economies of scale come in, we combine both of our offices, in different geographies across the world. We also impart certain knowledge from our operations to them. Cost comes down, revenue increases. We expect increase in revenue and profitability also to come in from iData.
Got it. Okay. All right. The other positive was the margin expansion. Is there any one-off in the overall margin expansion, and can you maintain these sort of margins?
Nigel, if you see last few years, BLS International, the margins have been growing constantly. So last year we reached 21%, which was an uptake of 500, 600 basis points from the year before. Now in this first quarter itself, we have reached 700, 600 basis point increase in margins. I think a couple of factors that have led to this increase is that we have got increase in service charges from new contracts that we are winning at a higher service charge. Existing client governments, the retenders also at higher service charges. We have also transformed our business model in certain countries where because of local laws, we were operating with local partners and there was a profit sharing. Now we have taken over with the change in laws in those countries, particularly in countries in Middle East like Saudi Arabia, in certain Latin American countries. So that has led to an increase in margins. And I feel definitely this will be sustainable. And our endeavor, as always, will be even to take it further, increase in margins.
Okay. This cash on the books, right? Almost 1,300 crores. Any kind of use for that in this year? Any acquisitions that you're looking at? If yes, what are the geographies? What's the domain? And any timelines?
See, the cash on the books is before the acquisitions were announced. So this was the end of first quarter. I think in July, we've already paid for the acquisitions that we did of iData. And in BLS E-Services also, we have announced the acquisition of Idealis Loan Solution, which is a 200 crore company, where we were acquiring 55%. So certain cash will be utilized in that also. So after that, the cash that will be left and the further cash flow that will be generated in the next 1-2 years will be further used in, we are looking at more acquisitions in the near future, and looking at the growth of the company and reinvesting the money also in further geographical expansion, new contracts that are poised to come, technology, and also dividend to the shareholders.
Okay. All right. Useful. Thank you very much for joining us with that commentary. Appreciate you coming on with all of that. Shikhar, appreciate your time here on CNBC-TV18. GIFT Nifty will come up on your screen. Just take a quick look at what the start is looking like. We'll also just put up what the Asian markets are doing. And then we'll slip into a break because we also want to get you the technical trading ideas with our experts in a bit. So 200 points still higher, 24,295. Yesterday, we started 400 points down on the Nifty, and then it looked like it was steadying a little bit. 24,300 was being defended. Then within the next 30-40 minutes, 24,200 was broken. A bit of stabilization, and then of course in the second half, you lost some more. So finally ended, I think, about 700 points, just under 700 points lower after starting with a 400-point cut. So you're going to start to recoup some of that this morning. I wanted to look at Nikkei and what that is doing, because yesterday that market lost 12.5%. Not so much the Japanese equity market, but what was happening with the currency there was a big reason why global markets were in a bit of a dizzy. That currency is rallied from 162 to 142 yesterday, and right now you are having the yen is lower, the dollar is higher, so 145.56 is what you have on the USD JPY. We'll take a break. We are back with, of course, our technical trading experts. So some calls coming your way in a bit from now. Welcome back. News at the bottom of the screen. The Japan Finance Ministry and the Bank of Japan are going to hold a three-way meeting this morning at 11:30 a.m. That is the news which is coming through. Will they take action? Remember, all this basically started with the bank. I mean, markets were not expecting the Bank of Japan to do anything last week, or maybe it was the week before, but basically a few days ago, I think it was last week. But what the Bank of Japan did is they did a hawkish hike. And that raised expectations that, while the rest of the world is waiting for rate cuts, Bank of Japan is essentially on a hiking spree or will be on a hiking spree. But with all the turmoil that we've seen yesterday, I think that is extremely unlikely that they will sort of continue to hike, through all of this. They'll have to sort of acknowledge what has happened to the yen. And of course, I mean, to the equity market as well, and the panic that it has set off around the world. Would they do something? Is essentially the question, especially with the yen moving 20 handles from 162 to 142 yesterday. Will they step in some way? So we'll know more during the course of the day. I think this is the first concrete central bank sort of regulatory announcement which is coming from global markets. People were yesterday talking about the Fed, but so far, nothing. Mitesh Thakkar and Sudarshan Sukhani are with us with what they'd want you to do in terms of trading setup and trading strategies. Gentlemen, good morning. Good to have both of you here. Mitesh, what is your sense? Is the panic for now done? The worst of the panic, let me put it that way. Volatility, yes, will continue. And how would you trade it?
Morning, Prashant. My sense is that yesterday we got what I will call as a weekly gap. And that could, be something which could be a trend changer for a medium term. So unless until the gap gets fit, which means that the Nifty starts scaling beyond the previous week's low of 24,700, I think that's a respite then. But if that doesn't happen in the next few days, I think there's a good chance that we will see slightly lower levels, and this correction could be a bit more deeper than what we have seen till now. So it could be if you give it about 2-3 weeks kind of perspective, it could be down to about 26,400, 500 zones. So slightly negative. Today we are seeing some kind of a positive gap up opening, given the fact that the Asian markets have rebounded well. But in the immediate term, again, 24,500 or 540 zone would be very important on the Nifty spot. And I think as we get closer, we should see higher supply emerge. And clearly, I think, if we see on the hourly chart that the market is not sustaining around those levels, I would even want to get into short positions. A lot of stocks have broken down, given some kind of short-term trend reversal signal. So the overall bias is that this correction could be slightly more deeper, though today could be a day of pullback.
What about individual stocks? All right, Sudarshan Sukhani is also joining in, so let's get his view. Sudarshan, hi, good morning. Do you think that the worst of the fall is behind us, or could there be some more? And what's the way to approach individual stocks now?
Sure. Good morning. I'm not sure what worst of the fall means. If it means that the volatility that we saw is behind us, the answer is yes. The extreme volatility that we have seen is unlikely to be replicated soon. That was unusual. But the decline probably has not come to an end. We have started a correction. That correction has also entered into a seasonally downtrending period, August and September. So I don't think the downtrend is over. But probably it will be much more orderly than what we have seen in the last 2 days. So to that extent, it will be easier to manage. So that is the view that we are probably looking at lower levels soon enough. For the day, there is a relief rally. And even when there is a correction, since the overall trend is up, relief rallies could easily be bought into. So buy a dip today and keep it intraday. We'll see what happens tomorrow. Now we are talking about stocks. Stocks are a mixed bag. I have Balkrishna Industries, which is an intraday short, the stop above 33.62. Then Dixon is an intraday short with a stop above 12,112. And there are two buying opportunities. Keep them as positional buys, and both come from the FMCG sector. Hindustan Unilever with a stop under 26.67 and Tata Consumer with a stop under 11.82. But remember, they are not today. They are for positional trades.
Okay, and Mitesh, what about you?
I have more of sell calls. The only buy on the list is Asian Paints with a stop at 30.63 for targets of 31.50. And on the sell side is, I would want to use the bounce back to possibly look at some weak stocks which to decline further. Ambuja is a sell around 640, 645 range. Keep a stop at 656. Look for targets of 615. Concor around 990 could be a good shot with a stop at 1020 for targets of 935, and IRCTC sell around 935 with a stop at 955 for targets of 855.
Okay, all right. Mitesh and Sudarshan, thank you very much, both of you, for joining in with that perspective. We'll take a quick commercial break here. We're going to come back with the pre-open rates. We'll also propose sale of ICICI securities, and we put the focus on falling oil prices. That's the silver lining in all of this for a market like India from a real economy perspective, and maybe for some stocks as well. Stay tuned, that's coming up.
Well, it may not be prudent to celebrate too early because we are seeing a bit of green on the screen, but then we could also see a lot of volatility given, the kind of turbulent global cues we have upon us. Sneha Seth, the derivatives research analyst at Angel One, is with us. Sneha, hi, good morning. How are you approaching the markets today, and what are the stocks to look at?
Very good morning, Sonia. If you look at yesterday's selling, I think we may see a continuation of this selling pressure going ahead. Looking at especially the IVs, which surged more than 40% yesterday, now trading around 20% and above levels. So at present, I believe the gap zone around 24, 350, 700 should be acting as a resistance. On the lower side, any correction below 23, 900. That can bring index at least towards the 89 EMA, which is placed around 23,400. So I would suggest that anyone who is holding any long position should prefer, exiting their longs in case of any bounce back. And someone who wants to go ahead and long, I would say wait for some more time, avoid any kind of a bottom fishing at present. In individual counters, I have two sell calls. The first one is on ICICI Bank. If you look at this counter, it has been recently in pressure. Yesterday also we have seen addition of short position. So I believe we may see a continuation of selling pressure at least towards the 89 EMA. So I would recommend selling with a strict stop loss of 1190 and the target expected will be 1150. Apart from this, M&M is a sell. Again, this counter in last 3 sessions has, added decent short positions. I believe we may see further selling pressure. So I would recommend selling with a strict stop loss of 2734 and the target expected will be around 2547.
Okay, thanks a lot for that. So those are some calls coming in from Angel One. But here's also one equity market view for you. Lawrence Belanco of CLSA says that the Nifty has outperformed by falling less. Nevertheless, in absolute terms, the index is now testing support provided by the 50 DMA at 23,905. He also says failure to hold this level would leave the Nifty vulnerable to drop back to the upper boundary of the March to May trading range of 22,775 to 22,800.
That is some distance off if it were to come to pass. But that's somebody whose technical views are closely watched. I want to just put out Victor Schwetz, who's also a very closely followed macroeconomist, and he's, of course, with Macquarie, who says, it's a commentary about the recent sort of events. He says, given the sell-off in Asia and a spike in wicks above 50, the question is what dangers are investors facing? Does it require joining the stampede or create a buying opportunity? Victor says that the sell-off was precipitated by a confluence of events, that is, perception that the Fed is behind the curve, investor concerns that, and I quote, tech bubble is bursting. Third, potentially disruptive unwind of the yen carry trade, and authoritarian regimes view such volatility as evidence of fragility of the West, potentially encouraging geopolitical adventurism. Although stampedes are inherently unpredictable, Victor says, he's viewing this as closer to irrational, all of this sort of panic and mayhem, thus creating buying rather than selling opportunities. So that's a broad sort of global view which is coming in from someone who tracks this stuff pretty closely. Nigel.
Okay, all right. Well, let's focus on the oil and gas space. Then we have Prabal Sen, who joins us to help us out with a quick take on how things are shaping out there. Hi, Prabal. Good morning, and thanks a lot for joining in. Well, we had ONGC's numbers. As per your reading, how was it, and what's the view on the stock from here on?
ONGC, I think operationally the numbers were broadly in line. In fact, EBITDA was probably a bit ahead of our as well as the street estimates, from what I reckon. On the net earnings line, obviously, there's a few line items that we'll have to still look at in the call. I think depreciation plus exploration write-offs were perhaps a bit higher. than what we were anticipating. So for that reason, net earnings probably missed estimates a bit. As far as the stock is concerned, I think, we maintained this for a while that it's a very binary situation as far as the stock is concerned. If the KG Basin asset performs as has been guided, and from H2 onwards, the YOY growth actually starts to come back in terms of overall production numbers, we see no reason why the stock cannot, continue to outperform even from these levels. But if there is disappointment on that front, there is, a little bit of a downside risk that can actually emerge, because at the end of the day, the main thing that has driven the stock up has been the optimism around, reversal of the last 7-8 year trend of declining production in the standalone numbers. So to that extent, I think that is the main monitorable that we'll continue to look at and continue to track. And that is what, we would look forward to in terms of management commentary in today's call, I think, which is scheduled at 3:30. So for now, we continue to be positive. We believe that, if that production growth comes through both on a standalone as well as on a consolidated level, I think the stock stands to probably perform well from here on.
Okay, all right, Prabal. So KG Basin is something that we'll track. For the time being, you continue to remain optimistic on prospects. Also, I wanted to ask you about IGL and MGL. Both of them saw a beat on the margins. But do you think there's a risk on the volume parameter from here on? And what's the view on both these two names?
So I think, firstly, as far as volume growth is concerned, particularly if the moderation in, the LNG prices continues to be there, and very clearly, if you look at global estimates of LNG supply additions, there's probably around 170 to 180 million tons of fresh liquefaction supply that's expected to come online in the next 4 to 5 years. So to that extent, if you look at demand additions, most estimates will be between 25 to 30 million tons. Now, the timing of the supply additions may not coincide with the way demand grows, obviously. So there could be probably a bit of tightness still in this year and part of the next. But from a 5-year perspective, LNG supply, I think, is looking to be in surplus, which is obviously good news for gas consumers here. Because at the end of the day, whatever growth has happened in domestic supply, we still will continue to import between 45 to 55% of our requirements from the LNG route. So I think from a margin and pricing power perspective, we remain fairly confident that the CGD companies will continue to do well and continue to perform strongly. Our pecking order, I think MGL we probably like a bit more, because valuations we believe are much more attractive, despite the fact that now earnings growth as well as volume growth for MGL is now coinciding with their larger peers, while their margin strength, I think, continues to remain probably better compared to some of their peers. So between MGL and IGL, we will continue to prefer MGL at these levels. But on the whole, the CGD space itself, I think, looks pretty good to us from a pricing and margins perspective.
Okay, thanks a lot for that, Prabal. Have a great day. That's the word coming in on some of these oil and gas stocks. But let's get to the market now. We have a market that's opening in less than 10 minutes from now. And looks like it's going to be a decent opening. 130 points in the green for the Nifty. Let's see whether we can build on to our gains or not. Sudarshan Sukhani is back with us. Sudarshan, what's the big call at 9:10?
Consider buying Tata Consumer Products with a stop under 1182.
And Mitesh, what about you?
I recommend selling into Concor around 990 for targets of 935.
Okay, Nimesh is also with us. Tell us about the standout brokerage report of the day. Nimesh, over to you.
Hi, Sonia. Morning. So today's standout is on Birlasoft. An interesting upgrade from Macquarie. They've upgraded the stock to outperform from neutral, and they've retained a target price of 720. But they believe that after the recent correction, remember the stock is down 15% in the last few days. They see a good entry point into the stock at these levels. While Q1, revenues declined 2% quarter-on-quarter, management did cite delays in terms of project ramp-up in the manufacturing and healthcare vertical. However, Q2 could be much better according to the management, and they see a better revenue performance and deal wins as well. In fact, Macquarie says that they see a trigger for EBITDA margin to recover back to 14 to 16% and an improvement in the sequential growth as well. So post the recent correction, a good entry point according to Macquarie, and hence they've upgraded the stock now to outperform with a target price of 720 on Birlasoft.
Okay, all right. Thanks very much for that. Nimesh, thank you for getting us that we own Birlasoft. Tata Chemicals is the other one we want to shine the spotlight back on again. Sonal is here with that. Sonal.
Well, Tata Chemicals numbers looked weak on a YY basis. There was a revenue decline, then EBITDA decline. Revenues were down 10%, EBITDA declined 45%. The margins were lower by almost 900 basis points. Profits were down 67% as well. But the positive this time is that there's a quarter-on-quarter recovery in margins. Margins came in at 15% versus 13% on a quarter-on-quarter basis. Now, if we talk about the segmental breakup, the basic chemistry business saw revenue growth of 17%, but EBIT there declined by 62%. In the specialty products, revenues were down 1.6% and EBIT was down 8% as well. The net debt has increased and the company says that is because of working capital requirements. In their commentary, the management says that in India, demand was stable across all end-use industries. Demand for flat glass, container glass and solar glass is robust. In America, demand is flat, but in Europe, it's muted. But a positive comment came on Turkey because Turkey, remember, had been dumping a lot of soda ash at lower prices, leading to lower pricing. They say that competition from Turkey may decrease due to higher shipping costs. So that's a positive. Net debt increased because of higher working capital loans and capitalization of leases. So it's a weak number on a YY basis, but sequential recovery is a positive. Also remember, Tata Sons has become debt-free because of some receipts they have from TCS, and this indicates that there's no IPO for Tata Sons which is possible, they would go ahead with. So the Tata Group also is in focus.
Okay, all right, Sonal, thank you very much for that. Something to keep an eye out on. But Sonal, tell us about Deepak Nitrite as well.
Well, Deepak Nitrite, good set of numbers. This is after a long time because remember, phenol spreads have been positive. The commodity cycle has turned a little bit in favor of Deepak Nitrite. Even quarter on quarter, there has been a recovery and it was led by the phenolics division. Overall, revenues were up 22%, EBITDA was up 47%, margins higher by 300 basis points, and profits also, they went up by 35% to come at 202 crore rupees. If we talk about the segmental performance, for the advanced intermediate segment, the revenues were flat on a YY basis, but EBIT declined by 42% to come at 66.5 crore rupees. If we strip off the one-off item in the last quarter, the EBIT is up 23% on a sequential basis. So that is a positive. Phenolics saw good growth. Revenues up 37%, EBIT up 137% to come at 207 crore rupees. And the conference call is tomorrow. We'll get more details on demand and general recovery in the chemical space as well.
Okay, thanks a lot for that. Well, we just have about a minute to go for the markets to open. And remember, yesterday was a very steep fall, but this morning looks like the market could open in the green. What's leading from the front is the laggards of yesterday. So all of your global-facing stocks, even something like an ONGC numbers were above street estimates. So the stock is up 1.5%. Apart from that, Adani Ports, Hindalco, Maruti Suzuki is coming back, after yesterday's fall. Biocon has some news flow going for itself, so that's in the news as well. And then you have a lot of these other auto stocks that are not looking too bad either. So just remember that this is a market that has started some sort of pullback or correction. Today, maybe you could see a relief, but there could be a lot of volatility as well because global news flow is not great. Yes, there's been a pullback in global markets overnight, but we've still seen some deep damage in the last couple of days. So yes, we might be getting carried away with this 120-point move today, but we need to sort of realize that there could be a lot of volatility.
Yeah, I mean, you could say that a correction is a correction, as I think Sudarshan and Mitesh both said. But I think there is an orderly kind of a correction, and these panic 600, 700, 800 point. I think the panic bit is what as we've been saying, perhaps maybe behind us. But expect lots of volatility, and these things, when they happen, they take time to finally settle down. You should be ready for that. I think at some point you'd lose that starting 100-point advantage. Perhaps you'd go in the negative, then you'd have a sharp bounce again. But that's the way the market starts to find its feet back again. Even if you're entering, or you'd rather finishing something on the upside and starting maybe a more sideways kind of a move. But the point is, it'll be good if this sort of panicky, sharp moves, 3, 4, 5% kind of moves, we put that behind. Well, market open on your screen. The first trades, 160, 170 points higher, I think is where we are starting on the Nifty. We'll have the 240 points actually. So 24,300 plus. This is around the level where we started yesterday. So, straight off after the close on Friday, we started at about 24,300 and we are back there at this point in time. So about 285 points in the green, 1% plus. Bank Nifty is starting about 0.9%. Of course, Nifty Bank has been much weaker. At yesterday's low, the Nifty Bank took support of the 50% retracement of the rally, which began on the 4th of June low, the election day low, to the all-time high. So we've already retraced here on the Nifty Bank, 50% of that entire move. Mid-cap index is starting 2% in the green. That's good. 56,986. I mean, even if large caps do what they do, if broader markets are more robust, I mean, you'd find more people looking upbeat rather than downbeat. Advanced decline is good, 344 down, and about 1,400 stocks which are higher at this point in time. So a good-looking start with about 290, 300 points on the board, 24,345.
Okay, and the 24,300 is something that the market has now conquered yet again. Sensex back up 930 points. So one up day, one down day, a lot of volatility. But today, the market is in the favor of the bulls for sure. Tata Motors is your top gainer, up almost 4%. ONGC as well, after the good numbers, up about 3%. Adani Ports, L&T, Maruti Suzuki, Tata Steel, a couple of other names that are surging this morning. On the downside, barely any stocks. Apollo Hospitals, SBI Life and H2L. Apart from that, you have, a lot of stocks that are in the news in the broader markets. But for now, the start is looking very good.
Well, that's right, Sonia. And just take a look at a few stocks. You have V-Mart Retail. The stock is flying away. It's up more than 10%. We're talking about a wobbly market. The street likes those numbers. The margins have expanded by 500 basis points. So good going out there. They reported a profit that compares with a loss. Another stock, cash market stock from the broader markets is Indraprastha Medical. Well, out there, those numbers look quite good. And it seems the street likes it because that stock as well has opened up with a big gain. I think it's up close to around 15% as we speak. It was, I think, locked up and now it's moved higher. Indraprastha Medical is the one that we're talking about, 18% higher on that name as well. So good up move is what we're seeing on that stock. Zomato, back to its winning ways. The stock is up close to around 5%. You have PFC as well that's bouncing back after the sharp decline we saw yesterday. So that stock is higher. Godrej Property is up 4.5%. So good move on that one. And these metal-related names as well that got spanked yesterday, well, they have pulled back a little bit. You have SAIL that's up and about in today's trading session. Marico, though, that stock is under pressure. It's down close to around 3% odd. But a good start to the trading session. The Nifty is up more than 250 points. You'll want it to build on its gains. And the broader markets, an exact opposite of what we saw yesterday. When we started off trade yesterday, you had only 150 stocks that were advancing and all the other stocks were declining. Today, you have only 150 stocks that are declining. So the advanced decline ratio should come up for you. Good looking. Let's hope we build on from here. Prashant.
Absolutely. Motherson is the top volume-led gainer across the board at this point. Stocks at about 184 and volumes are very, very large. So there's a 5% gain. Mazgaon Dock is coming up with a 3% gain. You mentioned PFC. PFC is about 4.5 higher. REC is also up about 4%. It's actually giving up some gains, but 3.6 odd higher on REC as well. There is Cera Sanitary Ware, which is jumping another 7%. Cera was up strongly yesterday as well. Friday's close on the name was 8,900. Yesterday's close was 9,400. And stocks at about 1,080 right now. And volumes are also not bad for this point in the day. We've got IREDA, which is up 4.5%, 250. I'm not sure what's happening with Lux, but again, from 2,070 to about 2,400, Friday to today. So that's a big mover yesterday and on the upside and today as well. So these stand out because market's been down otherwise. NBCC is up about 3.5%. Stocks at 174. Bombay Stock Exchange is up 3%. So it's been, BSE has been all over the place. I mean, the recent low was 2,100. Then it rallied to a high of 2,600. And of course, yesterday it fell to a low of about 2,340 and coming back up a little bit right now. We had the management of BLS in the morning. BLS is up 6%. It's off the highs though, BLS, but it's still got solid gains. That's Bombay, London, Singapore. Yeah, that's one. So 372 on BLS. Brigade is up 5%. Stocks at 1176. Titagarh is up 4.5%. Hoodco is up 3.6%. Schneider is up 7.5%. Is it reacting to earnings? I'm not sure, but that's a large move on a large stock coming through. KPIT, HBL Power, EMS Limited. I could go on. with what's happening out there. Market breadth is also very, very positive,
Just
as you
one
highlighted.
more stock, Gokuldas. Just
Yeah.
want to highlight that stock. You know, we'll try to reach out to the management as well. I think Bangladesh, I'm looking at the 2022 numbers, and Bangladesh contributed close to around 11% of the total global exports in the apparel segment. And that's where Gokuldas, caters to. So because of that, it appears the street senses that there could be an opportunity. 11% of the total contribution came in for Bangladesh. So I guess that's the reason why that one is flying away, up close to around 8%.
Also, just want to mention two sets of stocks. One is the real estate names that are all rallying this morning. We were just reading about that possibility of the government preferring grandfathering till July 2024 as a relief to counter the removal of the indexation for real estate. The decision is not finalized just yet, but the possibility of that indexation relief is something that's getting all the real estate stocks up and about. And Prashant was talking about Motherson Wiring. Good set of numbers, more on that later, but the revenue growth of 15%, EBITDA growth of 15%, profit growth of 21%. So Motherson Wiring is up and about on that.
Gokuldas, we'll try and have the management join us on the air because the incumbent Prime Minister has been deposed. I mean, she's out of the country now, Sheikh Hasina. The government's gone. And of course, a new government will be formed in consultation with the army. But generally, I mean, is the interpretation that there is more certainty and operations were effected and they kind of are back on track now? So of course, I mean, market is collective wisdom. So this is being read as positive, certainly positive. 9.5% now on Gokuldas exports, 1,010, 1,015. As I said, we'll try and have Siva, the CEO of Gokuldas, join us to explain to us what the situation there is with their operations specifically. And of course, Bangladesh is the market as well. Pankaj Murarka is with us now, CEO and CIO at Renaissance Investment Managers. Pankaj, good morning. Great to have you with us here. Thank you for your time. Appreciate it. So we've been through a lot of volatility over the last 48 hours, maybe a little bit more. Started last week, and of course yesterday was a bit all over the place. What is your own sense as someone who's seen markets a long time, Pankaj? There will be more volatility. I think that is a given and all of that. But have global markets, to your mind, broken the sort of up and up phase at some level? So some of these growth concerns, etc., are back, especially for the largest, the US economy?
Morning, Prashant. Talking about global markets and the volatility that we've experienced over the day and a half yesterday and this morning, I think, Prashant, the fact is that there's a global reset. So far, the expectation was probably the US economy is holding very strongly and probably will have one or at max 2 rate cuts during the course of this year. Now, obviously, we've seen some weaker data points coming out of US, and the narrative has clearly changed where the underlying assumption is now we're expecting at least 100 basis points rate cuts in US before the end of this year. And probably yesterday there was chatter about an out-of-turn Fed meeting, which just happens in very exceptional cases. Obviously, money making has been very easy globally across financial markets in the last year or so, and the trade was very crowded, meaning the yen carry trade in terms of borrowing in yen, and meaning the simplest way to play a carry trade is you borrow in the currency with zero or least borrowing cost, which yen has been, and invest in the markets which give you the highest yield, which was people were borrowing in yen and investing into Mexico, where you can have 11% yield. And when money making becomes so easy, you have so much of this crowded trade playing out, and everyone is dancing close to the gate where everyone wants to just get out at the first sign of turbulence. And when you try to do that, that is what happens. What happened yesterday, you get a stampede. So I think probably we are here for some volatility. It will take some time to settle down, though I'm still of the view that I think recession in US is off the table. I still think that the underlying economy continues to be fairly resilient. But I think this is a pullback and probably a reset in a global macro. India relatively remains fairly stable in that sense, given our strong macroeconomic fundamentals, and we remain largely immune to the volatility globally, but there'll be rub-off effect in equities that we've seen yesterday. So I still think that globally, at least US is concerned, the bull market in US remains intact, and this is nothing but a correction in a bull market, but it couldn't sustain for some time, I would think.
Okay, this is a correction in a bull market, but it won't sustain for too long. Got it? So how do you approach the Indian markets now, Pankaj? Because, if global markets continue to be in turmoil, then a lot of global-facing sectors, whether it's autos, whether it's tech, whether it's steel, could maybe see some impact, right? I'm just trying to understand what's the best way to approach this market sectorally now.
Not really. My view is that talking about India, we've had a ferocious rally in the last 15 months in Indian equity markets. India has always been and continues to remain the most expensive equity market in the world. I believe once we are through this correction over the next 3-4 weeks, I believe there'll be a change in leadership in Indian equity markets. If you see through the last 15 months, the leadership has been through PSUs, engineering and capital goods and industrials, defense and railways. In most of these cases, I think, especially in case of defense, railways and industrials, while the underlying growth is strong, now stock prices are discounting or pricing in earnings 3 years out. So valuations are extremely rich in that sense. On the contrary, some of the sectors which have underperformed, which is essentially IT and technology, financials to a great extent, and consumers, I think there probably it looks like the worst is behind. As far as IT is concerned, I remain very sanguine, and I'm seeing initial signs of revival in tech spend by the top 2,000 companies or the Fortune 2,000 companies as we talk about. So I think we'll start seeing a recovery in IT going into the second half of this year, and probably much more stronger recovery in the next year. So we remain constructive on IT, and to that extent, I think once we have a rate cuts in US, probably starting September, I think India will also have it. We should expect a rate cuts in India, if not in this calendar year, probably early into the next year, which will certainly ease some of the liquidity concerns that most of the financials have been facing on the liability side of the balance sheet. So probably I think the underperformance of financials is also done. We've been underweight financials for now almost 2 years, but I think we are close to the end of that underperformance in that sense.
Hi, Pankaj. Good morning and good to see you, Ben. Pankaj, I wanted to ask you about, this entire liquidity at this, we have been talking about mutual funds itself are sitting in more than 1 lakh crore of liquidity, which can support the market as well. My question to you is, but part of that would be a requirement that they normally do, right? Maybe 40,000, 30, 40,000 of it. So actually the liquidity in the market is a little bit less. What's your comment? And how much can it cushion this global weakness that we're seeing?
Well, I think in the short term, liquidity can help, but eventually markets will find their own levels in that sense, Nigel. And I think given the ferocious move that we've had in Indian equity markets over the last 18 months, and we haven't had any correction in this leg of this bull market in the last 18 months, which is very unlike a typical bull market where you get a correction once in every 12 months or so. And whatever dips we got was just for a day or so during what we got during the election day or during the budget day. So probably I think we're in the middle of a proper correction in a bull market this time around. Corrections in a bull market generally tend to last anywhere between 3 to 8 weeks, and at the index level you can have a pullback of 10-12%, which is a normal bull market correction tends to be. So I still think while there's cash with mutual funds, but they will probably invest more wisely and there'll be buyers on dips. Having said that, I still think this correction will play out, will run its course over the next 3 to 6 weeks.
No, got it. Correction could go on for another 6 odd weeks or so. Another news flash there. Government calls an all-party meeting at 10 o'clock to discuss the ongoing situation in Bangladesh that is coming in from Delhi with the political turmoil in the neighboring country. Pankaj, I know in terms of your ideas, you really liked SBI. And you think SBI is the one name, large cap name, which perhaps continues to look very good. I think the other one, correct me if I'm wrong, was a name that you liked very much was Birla Soft. Talk to us about prospects for both and any other new ideas you may have.
Yeah, well, we continue to own both of them, Prashant. So I still think SBI as a franchise is still underappreciated by equity markets. I think the franchise is far more solid and far more valuable than what markets are pricing in. Clearly, we've seen in an environment over the last 2 years where there is, constraints of deposits and constraints on liquidity for most of the banks. SBI still has a very robust liability franchise or deposit franchise, which is very important for a long-term growth and sustainability of any bank or a lending institution, because lending is about a leverage business. Your ability to mobilize deposits is equally important. And I think SBI has one of the finest, we've seen the largest private sector bank, HDFC Bank, struggling with their deposit side of their balance sheet. So clearly shows that SBI is one of the most robust liability side of the balance sheet in that sense. And obviously, now with the changes they made during COVID and pre-COVID, when they went through their NPA cycle, it has a very robust lending side of the balance sheet as well. And as a bank which does 18% plus ROEs, I still think valuations are, meaning there's significant room for valuation improvement on SBI, and probably the market is underpricing the potential of the franchise in that sense. Likewise, we continue to remain positive on IT services. I continue to remain positive on IT services. My sense from talking to companies in India, and as well as listening to commentaries of global companies, there is a significant amount of pent-up IT spend which has been held back in the last 18 months or 2 years because of the rising rates in US. Now that the rate cycle in US is turning, I think all of those spends will be unleashed, or companies will start doing discretionary spend. And I think the entire, so in that context, we remain positive on the entire IT services. Amongst large caps, we have ownership across Infosys, TCS, and Tech Mahindra. We own a few mid caps and small caps as well. Birlasoft is one name which we like in the small caps. We think the company, as Birlasoft is concerned, they've gone a complete organizational reorg with the new CEO taking over about 1.5 years back, and probably have a much more focused approach on business. Probably a company which is, so one of the bigger play in IT services for smaller companies, we have a handful of companies in India which are about $500 million or thereabouts of revenue. Can these companies transition to crossing the $1 billion revenue mark over the next 3 to 5 years? And we clearly see Birlasoft is one of those companies which can certainly do that in that sense. And if any company which can make that transition, crossing the $1 billion revenue threshold, probably I think there is significant value creation that's there on the table for shareholders.
Okay. One final question to you. You know, we have a lot of these new age tech companies that have now started to do very well. Zomato is a clear case in point. And this whole consumption space is picking up as well. Do you think that this is just, a cyclical story, or is it some sort of structural upcycle that we're seeing in some of these names?
I'm a perma bull on all tech companies. I think the adoption or consumption of technology by all of us as consumers is only increasing, and it will continue to increase. I think we are at a very early stage of technology adoption in India. Just think about it. If you think about the 7 of the top 10 companies in US are technology companies, and these companies are just about 25 years old. They did not exist 25 years back. I think some of the leading companies of India, amongst the top 20 companies in India, will emerge from technology sector over the next 15, 20 years. So, Sonia, I am a perma bull on tech as a sector.
Pankaj, just in jest, perma, anything is, I mean, you've seen markets 30 years plus, and you're calling yourself, I'm surprised, perma bull. On IT, but...
Yeah, on technology, certainly yes, Prashant, because the trends I see, or what I've seen having played out in US over the last 30, 40 years in the US and the world, I certainly think it's going to rule the world. Some of the leading companies of India, 20 years out, just think about it. HDFC Bank was a startup in 97 when I started my career. Today it's the largest private sector bank of India, and probably among the market cap companies in India. All I'm saying is that some of the leading companies of India over the next 20 years will emerge from technology as a sector.
Okay, well, it's always good to hear that, especially in volatile times. It's always good to meet perma bulls, right? Thanks a lot, Pankaj, for joining, and have a great day. Let's focus on some primary market action now. Well, Firstcry's 4,200 crore IPO opens today for subscription. The issue comprises of an offer for sale of up to 54.3 million equity shares, or 2,500 crores. To discuss this in detail on the IPO offering and the growth outlook, we have Supam Maheshwari, the MD and CEO of Brainbees Solution, that is the parent company of Firstcry, that joins in here in the studio. Supam, thanks a lot for joining in. And, at the onset, I must say that being a mother, I think Firstcry was an app that I have used endlessly. There was a point in time when I was only using, Firstcry for my baby. But congratulations on, your sort of move towards Dalal Street and the impending listing. But just wanted to start by asking you about the industry itself, right? What proportion of the industry is unorganized currently? How much do you expect the shift will be to the organized sector?
Sure. First of all, thanks for having me here, and good to see that you were our customer as well. And you trusted us. So to answer your question, Sonia, I think, look, the overall industry is very, very big, which is around close to $34 billion as of today. It's going to become $66 billion by close to FY29. And within that, only 16% of the market today is organized. The rest 84% of the market is unorganized. The overall industry is growing at a 13-14% CAGR, where the organized industry, which is 16%, is growing at a 20% CAGR. So this is like a very, very sort of a massive TAM. As far as I'm talking about India childcare, for Brainbees overall, I think we are, our overall TAM, total addressable market, will be around $120 billion. So that's even bigger because we operate in 4 segments. If you put together all of the total addressable market, it's around $120 billion by FY29.
So, as a consumer, right, I've realized that, of course, there are apps and platforms like Firstcry, which is concentrated on childcare. And then there are a whole other set of apps as well, where you get everything, including childcare. So how do you differentiate? Sure. How do you combat this kind of competition?
So, look, no, it's a great question. So fundamentally, you have to look at, we are a specialist and a vertical retail player, which we have built over last 13 to 14 years, a certain set of competency to only focus on young mothers and fathers as our DNA and all the solutions that we have built. So let's say, for example, I'll enumerate few of them. The first of all is that we are a true multi-channel business model, which essentially means although our large part of our GMV, 75% of it comes from our online in India multi-channel retail, and 24-25% comes from our 1,063 shops that we have across 533 cities in the country. So in this particular category, mothers prefer to buy both online and offline. And that gives us a very unique power that we have a one trusted retail platform which has both significant online and significant offline presence across 1,063. That's number one. Number two, we run the largest parenting channel on YouTube, and we have a parenting community within our app. And this app allows a mother, when she conceives a baby, she goes through pregnancy, post-pregnancy, all the time till the time the kids become a certain age. She's very anxious. She's very inquisitive during that phase of that physiological change that goes on with her. She wants validation of oral queries and answers, and we have provided all of that through help of gynecologists, pediatricians, other fellow moms who have been through the journey, who are answering those questions like a Quora platform on. This is all happening within our app, and provide things like ovulation tracker to growth tracker, vaccination tracker, baby names, parenting GPT, all kind of stuff is embedded within the community. And this community resides.
We had all this back
it was not
5, 6 years, 7 years ago.
That's correct. So all of it is now live, kicking, running into the app, and this is within part of the shopping app. So some of these things are not going to be provided by anybody because we are true to that moment in the parenting journey. So this is like the second, and we have built a whole lot of curation, personalization. Like on our app, you will see a mother of a 4-month-old or a 4-year-old or a 8-year-old will see a very different homepage.
Okay.
That is very unique, very different than what you will see in a different typical app or any other marketplace.
All right, Shubham, talking about parents of 4 and 5, well, I have a 3-year-old and a 5-year-old, so I think you know that I would be a customer. I've seen the bills around the house. But let's focus a little bit on business because, a lot of our viewers would want to understand. I'm looking at your GMV. If I look at the mix, most of it is offline, right? Is online right now.
Yes.
But you're looking at, even upping the offline segment because you're adding stores. Tell us, what is the strategy out there? My understanding would be when you set up stores, it requires a lot of more working capital and things would be very, very different. So what is the strategy with regard to this mix of GMV, online versus offline?
Sure. So look, when we started our, business back then in 2010, we we always had believed that we will also solve all the solutions that we are building, we will solve for offline as well. Because India, back then in 2010, we believed 10 years, 15 years later, it will be still an offline market. And we are here after 14 years, it's still an offline market. E-commerce penetration is still in single digits.
Correct.
Having said this, we have built 1,063 stores. And in that, if you look at it, we are putting 350 more stores and the use of proceeds in the next 2 years.
Yes.
Our online will continue to grow of a very simple reason, because of the variety and because of the convenience that it offers and the curation and personalization that it offers.
Okay.
And more importantly, the millennial mothers that are out there are far more digitally savvy than what we had 3 years back, 5 years back, 10 years back. And that will continue to compound, because India is one of the most digital savviest country in the world. And therefore, millennial mothers will come to us first online, and they will also transact offline in the vicinity of their home.
Yeah.
That's what will continue to happen, and therefore, being the largest organized player in the market within a large TAM, and although we are still very small as a company, only 6,480 crores, but we will still continue to have a headroom without really not too much of both offline and online will continue to grow.
Got it, Supam. I think you did a detailed interview with Reema earlier, and I'd encourage our viewers who are thinking of applying into the IPO to sort of go watch that entire interview. But because for the paucity of time, I want to get a few things out of the way. Your EBITDA margins are at about 4% only. What is the roadmap? I mean, are we looking at steady expansion?
Sure, absolutely. Look, how it will actually happen if you look at our past track record we have 4 business segments. We are talking about 4.2% FY24 adjusted EBITDA. That's at a console level. In this, there are 2 new businesses which are less than 3-year-old. And these are typically all...
So 4 goes to what? I'm sorry, I'm pressing you.
Yeah, just take a minute. If you look at our India multi-channel alone, we were at 5.9% for FY22, 6.2 in FY23, and in FY24 we already become 8.8. So our core business, which is the largest piece of our business, has been in the making for 13 to 14 years, is already delivered 8.8% adjusted EBITDA. So this will continue to expand as what we have demonstrated in the past, because of all the things and all the strengths and moats that we have built.
Do you have visibility to get to double digits?
Like others have done it, we should be able to do it. There is no doubt and question in our mind.
And when do you take profitable? When do you become profitable at a net level?
It's as we, as all our 4 business segments continue to deliver better results over a period of time, because they are relatively new. Some of them are relatively new. All of this will translate into a sort of a pattern of PBT performance.
Absolutely. Thanks very much, Supam. Apologies for pressing you paucity of time. Thank you very much, and good luck with the IPO. And once again, to all our viewers who are thinking of wanting to know more about the company, I encourage you to go online to the website, the CNBC website, and watch that detailed interview with Supam and the Firstcry management. Well, let's focus on the real estate sector now, and this is a big story which we are reporting on. Will the Finance Ministry review the new LTC, the long-term capital gains tax regime for the real estate sector? My colleague Shirin is joining in with exclusive details on the thinking with the government right now. Shirin, over to you.
Well, thanks very much, guys. Just for context, as we know that post the budget announcement, this is the one decision that has got the maximum amount of blowback and criticism from the general public. The likes of Mohandas Pai, etc., have, of course, been suggesting that the government consider some relief, specifically as far as the removal of indexation benefits for real estate are concerned. As my colleague Timothy had also reported about a week or so ago, there were 3 options that were being considered by the government. What we are given to understand at this point in time is that the government prefers grandfathering till 2024, which was one of the options on the table, because then there is no retrospective in terms of the government's action on LPCG and the removal of indexation. So that is a preferred option, but no final decision has been taken yet. The other option is, just like you have with the tax regime, there is the old tax regime which continues, and there is a new tax regime which also continues, and it is up to people to decide which one they want to opt for. In fact, as the Revenue Secretary told us, that they have seen cases where pretty much at the last moment people switch depending on where they feel that they are getting more benefits. That was an option on the table, and that is also being considered. But again, no final decision has been taken. And I just want to take viewers back to the conversation that I had with the finance minister as well as the finance secretary on specifically this issue on whether the government would consider any review, rollback or release. And the finance minister had basically said she would only respond in Parliament, and the finance secretary had said that it was a political call. So remember, the finance minister is expected to reply to the finance bill tomorrow. The possibility was that she would speak today, but I'm given to understand that she's likely to speak tomorrow now. And if any relief at all is likely, it will only be with respect to real estate. So final decision in the process of being taken. But again, I want to caveat this by saying that a decision has not been taken yet, and we will know more once the finance minister responds in Parliament in reply to the finance bill, which is expected now tomorrow.
Okay, Shireen, thanks a lot for that. Very, very important story there. And if any relief comes through, then it will be a big positive for, you're already seeing a lot of these real estate stocks rally at the moment in hope of some relief coming through. But this is just source-based at the moment. Thanks a lot, Shireen, for that. In the latest turn of events from the subcontinent, though, Bangladesh has been pushed to the brink after Prime Minister Sheikh Hasina resigned and fled the country amidst severe student protests and a brutal crackdown. The President of Bangladesh has dissolved the parliament and the army has announced an interim takeover of the government. Ajay Thakur, research analyst FMCG at Anand Rathi Institutional Equities, joins us now to discuss how the protests could affect Indian companies. Of course, there is a larger angle to this, but if we just drill it down to individual stocks and companies, Ajay, in your ambit or in your universe of stocks that you research, which are the ones that would be affected?
So Marico is one which has roughly about 11-12% kind of a revenue contribution coming from Bangladesh. So Bangladesh contributes roughly about 45 to 50% of the revenues to Marico's revenue. And that is one of the biggest in our space. After that, we have Imami, which has roughly about 4-5% revenue coming from the Bangladesh unit. We also have Bajaj Consumer, roughly about 6 to 7% revenue contribution from the Bangladesh market. There are others like Dabur, the Britannia, Brokerage Consumer, but they have a very small contribution, maybe around 1 or 2% kind of coming from the Bangladesh market. In the paint segment also, we have Kansai Nerolac, which has roughly about 2-2.5% revenue coming from the Bangladesh market.
Okay, all right. I wanted your view on Marico, since you said it has a decent enough exposure to revenues. What's the view on the stock right now? It's still lower with a cut-off closure on 3% odd.
So the company in the call also, they indicated that this kind of black swan event do happen. However, companies are looking at a longer term perspective. They are looking at diversifying, de-risking, and reducing their concentration on specific markets. So it's a more of a longer term kind of a play. But yeah, in the immediate kind of the near term, we believe there could be some implication, maybe a 1 or 2% kind of a knock on the sales can be expected from the Bangladesh market for the year as a whole for Marico.
Okay, that's on Marico. Can any other companies where you see any kind of impact, anything that we miss? I think Britannia, Nestle, Dabur, all of them get less than 2% revenues from Bangladesh, right? So doesn't seem to be a very big impact there. But anything else you'd want to leave us with?
No, I think these are the companies. Having said that, I believe it's a very small, and generally we do have seen, in the past also this kind of incidences. For the FMCG companies, the business do get, certain bit of implications, but the sales kind of recover. So it wouldn't have a material impact. Apart from Marico, I doubt there could be, material impact on the sales or revenues of many of these companies.
Okay, we will thank you on that note. We'll take a short commercial break. When we come back from the break, Mahinder Chhabra and Anurag Gehlot of Motherson Sumi Wiring will join in for their Q1 earnings. Stay tuned. So let's focus on Motherson Wiring now. It was a good set of numbers actually, a strong revenue growth, but the margins have contracted because of two reasons. One is higher raw material costs and the second is higher startup costs that they had to incur because of two new plants that are coming on stream, the greenfield plants. Their EV revenues have surged 50% year on year, and overall very good set of numbers. We have two gentlemen joining in, Mahinder Chhabra, who's the CFO, and we have Anurag Gehlot, who's the COO of the company. Gentlemen, morning to both of you. Mahinder, I want to start with you because the growth on the top line has been pretty good, 15%. Can you just take us through what are the demand trends now like, both in the domestic as well as in the export market overall? And particularly for domestic, what kind of reasonable growth can you see for the full year?
Yeah, sure. So thanks for getting us. So first of all, I think yes, there has been good revenue growth as you have highlighted, and it is mainly resulted by two factors. One is the industry growth. So if you look at the industry, the PV industry has grown by 6% in this quarter compared to previous year, the same quarter. And the second most important thing is the content. So if you look at people today, the customer, the final consumer is preferring high-end features in the cars. So which means more and more content. So if there are more features in the car, that means more content in terms of buying harness, and which is a good sign for us, which gives us pretty good revenue growth in terms of revenue growth.
Okay, so you said industry growth has been 6%, but the content per vehicle is rising. So by the end of FY25, what kind of top line growth are you looking at, Mahinder? And also this content per vehicle, right? How much can it rise to by the end of the year?
Yeah, so as far as year is concerned, I think we are positive about the industry, about the outlook. And if you look at most of the OEMs, they have already announced their expansion plans. Be it Maruti, Tata, or Mahindra, they have announced their expansion plans. So we are optimistic about the industry growth. And as far as content growth is concerned, we see this trend to continue. Consumer would keep on preferring the high-end features as far as PVs are concerned. So we see these trends to continue in terms of both the industry growth as well as the trend growth, the content.
Okay. Anurag, come in on this because, you know, the margins were impacted a little bit. There were, of course, startup costs because of your new greenfield plants, and also raw material costs have gone up. But now that copper prices are settling a bit, going forward, what kind of average margins can you do in the next couple of quarters?
Okay. First of all, thanks for inviting us on CNBC. Just would like to say, you know, EBITDA is, or margins are not something we keep a focus on. Our main focus remains on the ROCE. And I think if you've seen the last year results, they were 48%. Prior to that, it was 44%. This year also, we are also on the track, backed by the customer plans. Now, coming on to the new plants, obviously, these two new plants are ramping up phase. One plant is in Q2 and Q3, and one is going to happen in Q4 and Q1 of FY26. So these cost, because you have to train the manpower, you have to hire them in advance, you have to skill them to start making or giving the output what you need in when the ramping up is happening. So these are the cost, and which is very much visible in the P&L account also. And as we move forward, I think as Mahinder has also said that, you know, everybody is having increasing their capacities and investing into that. So we are seeing a good volume growth in the coming time. And I think, as I suggested, that our main focus remains on ROCE, and we are already in track on that.
No, I get that the focus on expanding the ROCE, but you know, you are seeing some startup costs, right? Higher startup costs which are impacting your earnings. So I just want to know, going forward, can you give us a ballpark number? How much incremental startup costs are you looking at, and how much could that impact your EBITDA in the very near term?
See, if you have seen the Q1 results also, you will find the manpower cost is the one cost where you will find around 1.5% something was a high on the in terms of hiring these manpower. So these are the percentages, but it all depends on how much large business or how much large unit is going to ramp up, because both of these units are having a multi-customers and a multi-model are going to be launched at a different point in time. So giving a number as a straight away on something is a very difficult, because it's a spread of people hiring and, you know, getting them trained.
Okay. The EV industry growth has picked up a lot, and even for your own business, right? EV revenues have gone up quite a bit. Mr. Chabra, I wanted your thoughts here. As a percentage of revenues, it's still a very small piece, about 5% for you now. But over the next, say, 2, 3, 4 quarters, how much can EVs pick up, and would that add to your content per vehicle further?
Yes. So first of all, yes, EV content is more in terms of wiring harness. The content in EV is more compared to ICE vehicles. As far as future is concerned, it largely depends on the market, largely depends on the customers. Because since we are supplied to the OEM, so if there is a more demand for the EVs, for sure our revenues should also increase in the same proportion or even better.
Okay, got that. Finally, then one word on the, you said the industry growth is coming at 6%, right? Would it stick to single-digit growth this year, Mahindra? Or is there a possibility of getting to double-digit growth for the industry in FY25?
So maybe I can request Anurag to take up that question.
Anurag, you want to take that?
Yes, surely. If you see that all the major OEMs in the country has already increasing their capacities. You talk about Maruti going from 2.3 million to around 4 million, and all these other customers like Mahindra and Mahindra, or you talk about Tata. Everybody is given their details in last quarter and prior to that. So if you see the last year also, it has grown into single-digit percentage higher side. Q1 also says about the same. So we think that the trend remains the same, or even looks positive to us. As far as MSFIL is concerned, obviously we are growing by double digit, because obviously there's a content involved into that. And that one is the volume growth is there. So I think market looks to be very positive to us, and we see a good time coming forward.
Okay, good times coming forward, and the market is very positive. I would have asked about the balance sheet, but there is big improvement in the balance sheet. You're debt free as well, so there's no point talking about that. All the best, with the way forward. Just wanted one word from your end, Anurag, on the capex, right? Given that you have some legroom now, you have a cleaner balance sheet. Would you be at any point in time taking on some debt, any incremental capex that you're looking to put on board over and above these two plants? These two greenfield plants that are coming on board?
See, for this financial year, we have a capex of approximately 200 crores. And I think this is including of two things, the new upcoming plants as well as the maintenance of the plants which are existing. We have total 28 plants, including these two new plants. And you will hear that a few more plants are also in the pipeline, which you will hear from us in the coming time.
Okay, all right. We leave it there, gentlemen. Thank you both for joining us with that perspective. Appreciate it here on CNBC TV18. So that's Motherson Wiring with some outlook coming through for their business going forward. Well, Mitesh is back with us with what he'd want you to do as far as individual trades are concerned, and of course the view on the index as well. We were up 300 points plus, we're about 285 points in the green. Lots happening. Market breadth is overwhelmingly positive. 2,000 stocks higher and about 400 stocks are down. So 5:1 advances to decline ratio. Mitesh, your thoughts on what you're seeing on the screen and your recommendations?
Good morning, Prashant. So I think, today with the gap up opening and some kind of reversal, I think we might give a pullback about 24,470, 480 on the Nifty, around those levels, give and take a few points. So I think we might have another 100 points on the upside. But I think if we don't show strength beyond 24,500, then I think in the next couple of days, we should again see some strong pressure coming in at higher levels and sell off. But that's the overall view on the index. But in the short term, I have a buy on Asian Paints. It's something which I've recommended repeatedly in the last few days. Now still showing strength today. Buy here with the stop at 3,100 or maybe just below it, and look for a target of around 3,200, 3,220 on the upside, and a sell on Steel Authority, which I would recommend selling with a stop at about 143.5, 143.75 for targets of around 133.
Okay, thanks a lot, Mitesh, for that. Well, let's track V-Mart Retail and find out why you should be watching that stock. Mangalam is here with the latest. Mangalam, over to you.
Good numbers coming in finally for V-Mart Retail. It's been many quarters of weakness. Weak sentiment is what everyone's talking about. At the same time, there were a lot of one-offs, etc. But despite that, of a low base, there has been strong recovery. The company's revenues in the quarter have grown 16%, and that's reflected in the EBITDA performance as well. A jump of almost 89% on the EBITDA, near 500 basis points improvement in the margins. And as a result of which, what was a loss of 22 crores at the same time last quarter has turned into a profit of close to around 12 crores as well. Internals are very strong. Same-store sales growth up 11%. Same-store volumes up 11%. Footfalls higher by 36%. And this, remember, despite there being extreme heat wave and there being disruptions around elections, etc. as well, sales per square feet have also increased by about 13%. And what's working for them, Unlimited, which was earlier a drag for them, is now showing improvement, signs of improvement. And also the digital market business, LimeRoad, which is now curtailing its losses, down 60% year-on-year and down 15% quarter-on-quarter. The company has guided for this to turn profitable at some point towards the end of this year itself. Now the key to track for them would be whether this recovery sustains post-monsoon as well and pick up in sales ahead of festive season. If all those were to happen, then we obviously see a lot better performance for V-Mart coming in over the next couple of quarters.
Okay, all right. Thank you very much, Mangalam, for that. So that is a look at what's happening there with V-Mart. We'll take a quick commercial break here. We put the focus on the commodity space. Manisha Gupta is going to be with us on the other side. Stay tuned. That's coming up.
Well, shifting focus to the commodity markets, Manisha Gupta is joining in. Manisha, what's the one commodity that you're tracking today?
Well, Sonia, I'm looking at metals as a sector. Most of the asset classes have seen a bit of a rebound, even gains today. But I can't say the same about metals as a place because we still suffer from poor demand for this sector. The inventories have been constantly rising in Shanghai, in Europe and US as well. And then it has been a barrage of weak economic data from US, Europe and majorly from China. For China, essentially, markets have been waiting for some big bang stimulus measures or some announcements, and we haven't heard any of those. There has been a bit here and there and in small quantum as well, and that really hasn't helped the markets. Apart from that, there also are recession concerns coming in for US. We have seen very weak data there, and the sell-off in other asset classes also seems to have broken the momentum when it comes to metals there. Dollar index is trading at a 5-month lows. We've seen that break below 103, so that could give some support at some point in the day today. And then apart from that, it also is about the US rate cut expectations. Those are a couple of factors that the metals, of course, will look at, as will other asset classes. But when you talk about the copper prices, we've seen constant decline onto this one. We did see an all-time high of $11,100 in the month of May. But from those kind of levels, the copper prices have declined almost at around 20%. If you look at copper inventories, they have gained up by nearly 140% in the last 3 months itself, at around 3-year highs onto that one. And if you look at the demand, well, it's trading at a discount in the Asian markets there. So constant pressure continuing in case of copper prices. Aluminum is no better. We are trading at a 5-month lows onto this one as well. If you look at the China aluminum June output, it gained up by 6% on a year-on-year basis. And we're looking at output in China at November 2014 highs. So that tells you that the inventories are building up, but the demand is not really coming here. Same is the case with lead and zinc, also trading at 4-month lows onto that one. Nickel prices are trading at a 5-month lows as well. And you have silver now trading at 3-month lows. So across metals as a sector, we are trading at a multi-month lows. And from the highs of 2024, we have seen the prices come off quite strongly. If you go by the textbook, then many of these metals actually are trading in a bear territory. You have 20% off in case of aluminum from its 2024 highs, 20% off in case of copper as well. Zinc has declined by 25% from the current year highs, and silver is down by 16% as well. It was just last month that we saw silver prices trade at all-time highs in the Indian markets. From those kind of levels, we are down 15% as well. So pressure, especially within this space, just about continues.
Okay, thanks a lot for that. Well, let's do one thing. Let's take a quick break. On the other side, our special segment is the economy. Lata will get chatting with Mitul Kotecha of Barclays and Jahangir Aziz of JP Morgan to put focus on the huge global market meltdown. Stay tuned.